What up, Hyperchange? Welcome to another episode. Got a super special guest podcast lined up for today. We have Luke Pappas on the line, who is a friend of mine, and he is on the investment team at NEA, New Enterprise Associates. Funny story, I went to business camp with Luke way back in the day in high school, and we recently reconnected. Just every time we have a phone call, I'm like, I wish this was a podcast that I could put out on Hyperchange. So now we're doing it. We're recording. The topic for today is going to be ride sharing, the future of companies like Uber and Lyft, how this bike sharing, scooter sharing movement is tying into the future of urban transport, and sort of going over the startup scene. So Luke, thanks for coming on the podcast.
Yeah, absolutely. Thanks for having me, and it was great to reconnect. Actually, funny story. I was just browsing through YouTube about a month and a half ago, and I saw all the great content from Hyperchange TV and some of the Tesla episodes. My brother actually works at Tesla, and I was doing some research for him on some of his options and his, whether or not he should take cash or stock options. And the analysis on Tesla was awesome. And I was like, man, we got to reconnect. And so it was awesome to reconnect about a month and a half ago, and looking forward to talking more about transportation space and scooter share and bike share and some of the phenomenon we're seeing in the venture landscape.
Definitely. So my understanding here is, and I think this is a really fascinating twist that's gone on in this industry here, of where, we started to see Uber and Lyft pop up, gain tremendous popularity. And I've always thought of them as taxi companies, ride sharing companies. The future of them would be to work on their autonomous vehicle programs and focus on this robot taxi revolution. But sort of in the last year, we've seen this incredible pivot towards integrating bike sharing and scooter sharing into these, apps and services. And so, I'm curious, maybe you could start, Luke, on like a high level of what you're seeing here and how this space has changed so dramatically in the past year.
Yeah, for sure. I mean, when you think about when Uber and Lyft first started, you had, similar to Airbnb too, you have a marketplace, right? You have supply and demand. You have the supply of drivers who have vehicles, and you have demand of riders, obviously. And one of the key innovations of these companies when they first started is you're pairing an underutilized asset, a driver with a vehicle who has time to drive and a vehicle that's otherwise sitting idle, and you're giving that supply side the ability to effectively better utilize that asset. And so you're pairing supply and demand with a rider that needs a ride and a driver in a car that's available to provide that transportation. And the market need for that was just tremendous, and you see that in just the insane growth that both Uber, Lyft, and then some of the international players that have sprung up in China and India and some other countries, just phenomenal growth in the venture landscape. But as you mentioned, in the last year, people are, transportation is there's not a perfect one size fits all solution. And if you think about trips, like especially in a city, if I'm trying to go 3 or 4 blocks, hopping in an Uber probably is not that practical. There may be traffic. You're going to sit in traffic. It may be faster to walk. The fare might be more expensive, for a short trip like that. And so recently, some of the cities, like New York City, had a bike share program for a while, and some other larger cities had these, but they were all docked. So you would go to a docking station, you would check out a bike, and then you would ride it, and then you'd have to return it to another docking station. And so the flexibility of your trips was still limited. But Bird actually launched. So Bird was the first to launch this notion of the dockless scooter. And there were some dockless bike companies. Lime Bike was as an example of that, where they launched effectively a bike that had a locking mechanism on the back tire, and you didn't have to dock it into a docking station. You could pick it up for wherever it was last dropped off by the past user, and then ride it to your destination and leave it at your destination. So it gives you far greater flexibility. What was that?
That's sort of the first big breakthrough here, is that it was dockless.
Exactly.
That seems like sort of a big unlock, or a piece of the unlock of the business model.
It's a huge part. It's a huge part of the product market fit innovation, is that you're giving users far more freedom, and so the flexibility of the trips you can take now. You've effectively opened up the entire city or the entire grid. You no longer have to go from docking station to docking station. So from a user perspective, it's a far greater experience. Now, one of the drawbacks to bikes is, if you think about, it's not that easy to ride in a suit or, business clothes. You got to pedal, so you're still providing, you make it sweaty as you're traveling. And so Bird launched a scooter in Santa Monica in late 2017 that was dockless. It's an electric scooter, and you effectively unlock it with an app. You pay $1 to unlock, and then about 15 cents for every minute that you're riding the scooter. And then as soon as you get to your destination, you close the ride in your app, and the scooter locks itself, and you park it, and you're off to your wherever you're going. So far greater flexibility, and has seen some very interesting adoption. Like consumers, very strong consumer brand affiliation and affinity, and people have really loved the service. But it has that's been the good side. There have been a number of challenges which we've seen in some of the regulatory rulings that have come down recently. But a very disruptive model to think about the transportation space. And Uber and Lyft are taking notice, and you can kind of see that in some of the investments they've made.
Yeah, and Luke, I'm curious, could you highlight more on the traction that you saw when Bird took off? Because I think that's what a lot of people miss about this space. They say, "Oh, so how can this scooter company be valued at $1 billion out of nowhere?" But what really I think the underlying story is we've almost never seen a service take off so quickly. And, the traction is the other side. So I'm curious if you could, explain from your perspective what you were thinking when you saw Bird and any sort of details on just how rapidly they grew.
Yeah. So I'll share some of the public information that both these companies have disclosed, just as some data points. And as you mentioned, it's pretty phenomenal growth. Lime eclipsed 6 million rides on scooters and bikes in their first year of operations, with 300,000 of those rides happening in San Francisco. Like that's just incredible growth, and it's very rare to see something of that scale that quickly. I mean, you think back to products like Napster, right, going from 0 to 10 million users in a year. Like that is just virtually unheard of, and this is like right on the cusp of that. Bird is close as well, and Bird is just scooters, right? That Lime number was both scooters and bikes. Bird reached 1 million rides in 7 months across 7 cities, and so those numbers, they speak to the product market fit and the demand on the consumer side. You're not going to be able to achieve those numbers by subsidizing this. It really speaks to the quality of the product market fit, which gets a venture investor super excited.
Definitely. And so then, let's talk about the business here, because a couple million rides is tens and tens of millions of revenue. And so I'm curious if you could, expand a little bit about the economics of this business. Like they're buying the scooter up front. That's why they're raising so much capital. They're deploying it in cities, and then they make back their investment slowly. And so I'm curious, what do you think about the economics? Is it looking like this will pay off? Is it going to become commoditized? Because anybody can just drop a scooter.
Yeah, and that's one of the key questions. When you're looking at an investment like this, obviously the quality of the product market fit is a very important part of the equation. But in the venture model, traditionally, it's fine to have losses up front, and that's part of the reason why venture exists, is that you're subsidizing a business early to fuel growth, under the belief that the business can get to profitability and sustainability in the long term, right? So that's traditionally how we invest. Now, part of the investing process, the earlier that we make an investment, is really evaluating the product market fit, which seems to be pretty clear here. The second part of that, though, is, as you mentioned, diving into the business model, the unit economics, and understanding, okay, is there a path to profitability? And what can this business eventually get to a standalone platform where it's generating cash flows and all of that? So if we dive into the scooter space, there's a couple key levers that I think that are important to think about. The first one, and you mentioned this, is just what does it cost to actually buy the scooter? If you think about the difference between Uber's model, which is the traditional rideshare model, that's a pure supply and demand marketplace model. But in the scooter context and the bike share context, it's a little bit different, because you don't have to pay. Your supply side is purely just capital based. You can buy, if you have capital, you can buy the scooters to meet the demand that you have, right? So you're not necessarily supply constrained, so long as you have enough capital, and that's part of the reason why you've seen so much capital deployed in the space. So on average, this can move based on volume pricing and such, but the majority of these companies are buying their scooters from Chinese manufacturers, and the price point is somewhere between $300 and $400 a scooter, and so that's due to your upfront cost that you to acquire the scooter, and then beyond that. You have two primary cost drivers in operating the network. The first one is these are electric scooters, and they have to be recharged every night. And so you look at like a company like Bird, for example, and they've started this a new model where they're effectively paying people to go and collect all these scooters, charge them overnight, and then bring them back out in the mornings and put them back out so people can ride them. And so people are actually creating side businesses, just like you have Uber drivers creating side businesses, and they're collecting these scooters and charging them, and actually making a pretty nice profit on the side. But that's a key cost driver for Bird. Every day you're paying $10 or $15 to recharge your scooters. The second key operating expense that you have is redistributing your scooters every morning, right? Because you have to have network balance in order to meet the demand for your ridership. And so you may have to pay a driver to go and collect up charged scooters and then put them out in places like in front of high-rise buildings where people are going to be walking out of and commuting to work, or in front of train stations or subway stations, so that the supply is in a place that's going to be convenient for the demand to ultimately get to. So, ultimately, I think it comes down to density. The greater density you have, the greater utilization you have of the asset, and ultimately that gives you a greater payback. And so we've seen numbers floated in the press of payback around anywhere from a month to as long as 4 months. But there are cases if you play with some of those levers where you can see under some fairly conservative assumptions, where you get to a point where a scooter lifespan is maybe only 4 or 5 months, and the scooter may not pay back over the life of the investment. And so that's where you have to think about, do we have enough density, do we have enough utilization where this actually makes economic sense in the long term? And so that's part of, from a venture context, what we think about, and is a key point of the decision, on the investment side in looking at a business like this.
So how easy is it for people to replicate what Bird is doing? Because now, as you said, Lime is now doing scooters, and it looks like it's just a race of who has the most capital, can put the most scooters out there and sort of like hold out the longest, and stay underwater the longest or be losing money. And so I'm curious, like when I get out of my apartment, I can get an Uber, I can get a Lyft, I can get a Via, I can get a Juno. Is that what the scooter market's going to evolve to? And how do you build a moat around the scooter business?
That's a great question, and one that I think is really key to, like, if you're going to underwrite an investment thesis in this space, that's a key question you have to answer. Because really, and I mentioned this earlier, on the supply side, it's just a function of how much capital you have. If you have capital, you can go out and buy scooters, and there is demand there. We see that in the adoption metrics we talked about earlier. There is clearly demand, and so if you finance that demand with capital to buy scooters and provide the supply, you can spin up a business very quickly, and you can see that in the rate at which both Bird and Lime have been able to expand across the U.S. I mean, each of those companies are in 50 plus cities across the United States. They're also international in Paris and Germany and other large cities and countries in Europe, and they've deployed in record time in weeks, right? And part that's actually raised some regulatory issues because it's governments don't move fast enough to really keep pace with this innovation. But to your point, it does feel a bit like it's a commodity service. And you have to wonder, if it really is just a capital game, is there long-term differentiation in this in the offering that actually gives you a long-term moat, or something that you can feel comfortable about having defensibility in the long term? Some of the things people have talked about in this space. One is, I mentioned the rebalancing of the network every day that you have to do. You can develop a data asset just looking at your user behavior and the patterns with which people are taking rides to identify places of demand in certain cities, and then rebalance or tweak your rebalancing algorithms to address that. There also has been talks of potentially hardware innovation in the space where you can potentially build your own scooter that has a greater range, greater lifespan, things that make it more economical to operate, that give you better profit margins when you ultimately do reach profitability, if you do reach profitability. But today, and one other thing people talk about a lot is the quality of the team. And so, both Bird and Lime, for example, the founding teams of those companies have come from rideshare backgrounds, and so they understand this the supply and demand dynamics of the space and how to think about rider acquisition and all of that piece. And so that's another point of differentiation. But I think that one of the biggest things, and you look at how much capital has been deployed just in the first half of 2018, over 3.5 billion across bike share and ride share. To me, that's an indicator of this has the feel of a first mover advantage. And whenever you have that, people try and deploy capital as quickly as possible to take advantage of that untapped white space. And so, to your point, it does feel like capital is what people are banking on as a point of differentiation, and just flooding the market with your supply, making it hard for somebody else to come in and compete with you. But time will tell. I mean, it's really hard to point to anything that's super clearly differentiated about either product, because both, whether you're riding a Lime scooter or a Bird scooter or any other service that were to spring up, it's effectively the same product. I mean, you're paying $1 or $1.50 and riding largely the same scooter, going at the same speed. So you're paying the same amount. The supply is largely the same. So it's very hard to think about what the long-term differentiation is. And that's part of the reason why I think people are deploying so much capital, is to try and just flood the market with supply and bank on a first mover advantage.
A concept that I think is really interesting is that Uber is trying to be the Amazon of transport. And so listening to Uber's CEO talk about these services and integrating them within the Uber app. And so then Uber sort of becomes this lead generation platform where you could either get in a Waymo, or you could get in a scooter, or you could get in a bike, or you could take a normal Uber, and they'll basically show you all the options. And by aggregating everything, they're sort of a one-stop shop, making it easier for the consumer. And so that, I don't know how that, I feel like that is the end game of how this scooter business actually works, is rolled up into some sort of bigger travel conglomerate, whether it's, I think Lyft and Uber will both be competing to be that service, but that's sort of the way I see this evolving. I don't know if they'll be able to stay as a standalone.
Yeah, well, it's I think you're spot on, and they're actually, we see that in some of the recent acquisitions and investments both companies have made. If you look at Uber, for example, Uber invested in Lime in the most recent round, and they also acquired Jump Bikes, which is an e-bike that's been deployed in San Francisco. And both of those options are going to be rolled out in the Uber application as options for riders. And Uber's also working with local governments to add public transport as an option. And then if you look at Lyft, for example, Lyft acquired Motivate, which is the largest operator of the docking bikes I mentioned earlier. And that's going to be an added unit of transportation to the Lyft app. And I agree with you. I mean, that's just the natural. Ultimately, you want to give the user greater flexibility and more optionality. Because what you want to avoid, what Uber and Lyft have right now that is a hugely valuable asset, is that they have a tremendous amount of demand that is opening both either the Uber app or the Lyft app, or sometimes both, in order to find a ride, right? And what you want to avoid in those cases is losing those users that are going to go somewhere else. And so you have to constantly think about, what is the next form of transportation that could potentially disrupt our existing platform, and get ahead of that curve so that you keep users on your platform, because that is your long-term asset that gives you sort of that long-term value creation. And I think as the regulatory landscape evolves, if you look at what New York City just announced, where they're going to be capping the number of Uber cars that they're going to allow, the number of TLC licenses they're going to grant for operations in New York City, that's an inherent ceiling on your rideshare business. For Uber, for example, in one of the largest markets that you're operating in, New York City. And so you naturally, if you're going to continue to drive growth in your business, you have to look elsewhere for other options of transportation so that you can continue to drive top line growth in your business. And so whether it's bike share, whether it's dockless scooters, whether it's public transport, these are all just natural extensions, I think, of the platform. And again, if you give your users greater optionality, you basically take away a reason why they would leave your platform. So it's also a form of long-term defensibility for both of these platforms.
Now I wonder do you think it's smarter for a company like Uber or Lyft? Because I'm getting mixed signals on this of whether they want to go vertical And, Uber's buying Jump. So they're sort of going vertical in bike sharing in that way. But with Lime, they're investing, letting Lime operate it, just integrating that into their service. So I don't even know if Uber and Lyft have decided, but I'm curious what you think from a business model standpoint is more strategic. If you were Uber, would you try and go vertical everywhere, or just somewhere, or just is it better to just be that software layer that's aggregating all of these? I wonder what are your thoughts on that?
Well, I mean, fundamentally, and this ties to one of the theses that we invest in, or whenever you see a platform, a software platform specifically, you have tremendous margin anytime you can build a software platform as a business model. That is, like, at least in my opinion, one of the best models you can build. When you have to actually, fund operations and start, paying, incurring your capex costs and all the costs that are associated with actually operating a network, that's where you get margin suppression, and there's just more moving parts in the business that make it harder to operate in both the short and the long term. I think in Uber's context, as you're adding these different mediums of transportation, ultimately it comes down to both the scale of the existing operation. If you compare Jump Bikes and Lime, for example, Lime is in a far greater number of geographies. They have far more units deployed in the field. Jump only had 250 bikes when Uber acquired them, so it's a much smaller scale operation. And the other thing I think you look at is the quality of the team that's actually operating the business. And if you believe that the team is one that can operate as a standalone entity, and all you need to do is provide effectively a partnership between that company and your company, where you give the company that is operating standalone the ability to plug into your user base and your ridership demand, and act more as a software platform. That to me, I think is probably the best end state. But also, like, if you have to acquire a business and operate it yourself because you believe it's a unit of transportation that's going to be a key part of the future of how people are going to move themselves, then I think that makes sense too. I would prefer the first option. If you have a super high quality team that has scale and you can provide increased demand to that platform, that to me is natural are natural synergies.
Yeah, and so I'm curious, sort of, I guess this is sort of like the hype way to say it, but is this a bubble? And I guess my 2 cents first is sort of that, like, people are urbanizing faster than ever. There's a massive pain point within urban transport, and it looks like these last mile bike scooter solutions could be addressing a key piece of that pain point, and that is why there's so much hype and so much capital flowing into this. And so I'm curious about whether, I don't know if you think it's a bubble, or are we sort of seeing like a sneak preview at what the future of cities and transportation is going to look like?
Yeah, it's a totally fair question. And I think if you look at Bird, for example, and look at the valuation spike, right? They raised it a $300 million or $400 million valuation in March, and then they raised it a $2 billion valuation in June, right? So literally 3-4 months span, and you're increasing your valuation by 4 or 5x. That is uncommon I think in any market, and I think when you see that, it's a naturally fair question to ask: is this a bubble? Is the hype getting ahead of the actual product and the service that you're investing in? I think if you look at it from a venture context, venture is a hits-driven business. If you think about investing a fund, a handful of the investments you're going to make, maybe 3 or 4 are going to be your large fund drivers, and then the majority of the investments that you make are, because you're investing earlier and there's more risk, they won't be as successful. It's just the natural, progression of early stage companies. And I think as you look at this market, both as a consumer, a user of the product, and also as an investor, what you see is a couple things. First of all, there is pretty insane product market fit, and that's what you see when you look at the numbers growing from doing 6 million rides, or in Lime's context across scooters and bikes, or a million rides in 7 months for Bird. Like, those are growth numbers you just don't see every day, and that's an indicator of a future market opportunity. And if you think about transportation, right? it's something everybody, it's a problem everybody has to address. Everyone's trying to go from point A to point B. You just have different point A's and point B's, but it's something that everybody deals with in their daily lives. And so what that means is you have a mass market consumer opportunity. And if you look at some of the outsized returns in both venture and also in the public markets, consumer companies that appeal to a huge number of users are where the majority of your outsized returns come from. And so, in the venture context, I think that's part of the reason why you're seeing some of the valuation increases. I mean, the more demand you have on the investor side, that's going to push the valuations higher and higher and make it more and more competitive to actually deploy capital. And that's part of what's fueling, I think, these valuation step ups. But there is substance behind that as well, and that's the market opportunity that I mentioned. The question is, as we talked about earlier, are these products that we're investing in, are these services long term? Are they differentiated in the long term, and can they be standalone businesses to capture this massive market opportunity? And that's something that that's the bet you take as an investor in this context is. You're betting that it does have staying power, and that the use case is one that is great enough where you're going to have long-term differentiation and long-term sustainability. Those that aren't investing, I think, are looking at this space and saying, I just don't see a point of differentiation here that I can hang my hat on and with confidence think that this business is going to be a long-term standalone business. At these valuations, it just doesn't make sense to me, right? So that's both sides of the table. I have a personal view on the space, but I'll reserve that. If anyone wants to follow up offline, I'm happy to talk more. I don't want to upset either Bird or Lime or tip our hand as an investor on the investing side, but happy to talk more offline about my personal views on the space. But I think you can make a case for both. Yes, it is a bubble, and you can also make a case for why you should underwrite an investment in the space, right?
Awesome. And great stuff, Luke. And I'm curious, like, before you leave, like, a last question would sort of be, this scooter bike sharing thing totally caught me by surprise, came out of left field, it seems like. So do you have any insight, as you're working for VC, you're maybe seeing ahead of the curve here? Is there another big twist in this urban transport business model that we're not seeing? Or I'm curious if you have any insight on what would be the next big innovation in this space.
Yeah, it's a great question, and I think if you can answer that question, you're going to make a lot of money because you can invest ahead of the curve, and that's ultimately the name of the game in venture or in any market you're investing in. There's a couple of things I think that are interesting. The first thing, is more on the city side. If you think about the streets, right? A street is effectively an asset for the city, and it's a channel through which people are moving themselves or objects are being moved. And today, the majority of the grid in our large urban areas are dominated by cars. And I think you have to ask yourself, is that long-term the most efficient use of the space, both from an energy perspective, the emissions these cars are producing, but also the space they take up. And so that's, I would argue the car is an inefficient use of that space. You just go outside and you look at the number of any car passing you, and you may have one or two seats occupied and 3 or 4 seats that are sitting empty. And then you have the trunk and the engine in the front. There's just a massive amount of space that's not being, in my opinion, utilized effectively. And so you have these, bikes, for example, you have scooters popping up that are smaller form factors and are more nimble to navigate and allow for greater throughput on streets. And so that's one, I think, in terms of a thesis and just thinking about or rethinking how we can actually utilize the asset of a street in the city. That's one area that I think people are starting to spend much more time thinking about, both from the city side, from a regulatory perspective. Like San Francisco, for example, you can no longer turn right on Market Street. They're trying to get all the cars off of Market Street so that it can be just bikes and skateboards and scooters. And that gives you higher throughput, right? That's part of the reason why they want to do that. The other side of the equation is what is going to be the actual vehicle that's going to be moving people. And I can tell you, I can't tip too many things, but we are seeing some very interesting designs on the vehicle side from manufacturing companies in China and also here in the U.S. With self-stabilization algorithms and mechanics that allow for somebody to stand on some moving platform and not feel like they're off balance, and things that are improving the safety of these vehicles. And then you also have the autonomous concept too, right? Where that's a totally, in my opinion, a totally achievable end state. The technology is on the brink. And that's Tesla's story very well, and I've been in a Tesla before, and on the freeway you take your hands off the wheel, and it's an incredible experience where the car is moving you and you don't have to intervene. Like, just an incredible experience. And you can think about that in the city context, and these networks of autonomous vehicles. It shows up at your door, you step in, it takes you where you want to go, and there's like no human intervention at all. That if we can get to that end state, then you can do so many interesting things from a throughput perspective, from an algorithmic perspective, to optimize your flow of traffic. So we'll see, man. But there's a lot of innovation happening. It's super exciting. That's part of the reason why I love this job so much. We get to work with so many innovative entrepreneurs and try to shape the future as best we can. And so it's there's a lot of exciting things to come. It is a huge market opportunity, a huge pain point today. I don't think we'll ever have an optimal solution, but I think the name of the game is to always try and make the next thing that you introduce just marginally better, right? And continue to make the service better, and continue to push progress forward. And I think if you can do that, that's what we try and achieve. And we'll see. But there's a lot of exciting things on the come. So
yeah, I love that last wrap up. It sounds like autonomous Segway 2.0 could be in the works.
Hey man, there's a lot of cool stuff. I just can't wait to be a user of these products.
Definitely. Well, thank you so much for coming on the podcast, Luke. We'll definitely have to do this again. I feel like we covered a ton of ground, and awesome just to get your, perspective as someone who's in Silicon Valley, watching this happen from the ground up. So really appreciate you sharing all your insight.
Yeah, totally. Love to be on the show, and thank you and the team for all the great work you guys do to try and bring finance to people and provide an unbiased perspective. It's a great platform you're building, so it's just an honor to be here.
Thanks, Luke. Awesome. Well, thank you guys for tuning in. Definitely leave comments below. I'll try and convince Luke to answer some of your comments as well. Want to know all of your feedback on this episode. What are your thoughts on Bird, the scooter companies, Uber and Lyft's role in this disruption we're seeing in urban transport? Also, if you like the show, definitely remember to check out our Patreon page and consider supporting there. Anyway, this is Hyperchange. I'll see you guys next time. Peace.